Hey everyone, welcome back to the channel, your number one source for income-oriented investing, how to generate passive income from a diversified portfolio of high-yield funds to reach financial freedom as soon as possible. Welcome to episode 38 in my monthly series where I'll give you a quick update on the overall stock market in the past month and of course review some of the most popular high-yielding income-oriented funds and covered call ETFs, of course, on both the Canadian and US stock markets. We'll see how they're doing. I'll let you know if there's any big news on any of them, any big updates. And of course, we'll try to determine which sectors are undervalued and which funds you could buy to really capitalize on that, because obviously you want to capitalize when something is low, giving us a good buying opportunity, right? So if you're new to the channel, welcome. My name is Adrian, my investing strategy, and this channel focuses on income-oriented investing. The primary objective is to generate relatively safe, consistent passive income forever. And one aspect or important aspect of my investing strategy and really investing in general, no matter what your strategy is to invest consistently over time, right? If you do, you tend to capture the average of the stock market, you dollar cost average, of course. And when it comes to income investing, you keep growing your income stream over time. So remember that I'm not against the more mainstream growth or dividend focused styles of investing. I think those two are great. They work really well long term, especially if you're more of a growth and total return focused investor. My style, however, really focuses on growing your passive income every single month to attain maximum cash flow. So let's get started. I'd like to take a moment to thank the sponsor of this video, Harvest Portfolios Group, a really good friend of the channel. Harvest is the second biggest covered call fund manager in terms of assets in Canada, and they have an amazing ETF, all-in-one ETF. You guys know I love these style ETFs called HDIF, the Harvest Diversified Monthly Income ETF, which literally combines 6 of Harvest's best covered call ETFs. And on top of that, they add modest 25% leverage, giving you a nice all-in-one diversified product with over 10% yield. Really, really awesome. You guys know this is actually the second biggest position in my personal portfolio. And guess what? In case you're not very comfortable with the leverage or that little added volatility, they just came out with a non-leveraged version of the exact same product, HRIF, the Harvest Diversified Equity Income ETF. And you could get about 8% yield with that one. Awesome. Make sure you check out their website, check out their funds in detail. They have a great website, by the way, harvestportfolios.com. So looking at the market, let's check out what the market has done in the last month. I'm filming this, by the way, on May 1st. So we'll check out the US indices first. S&P 500. You see it changing live there because I'm actually filming while the market is still open. So in the past month here, up 1.11%. The NASDAQ is up 1% in the past month. The Canadian index, the TSX Composite Index, is up 1.89%. So overall, it was a pretty decent, good month for both stock markets. I think there is some positive momentum. Of course, we're still on hold waiting. The big news is always inflation. And I think the key date is, I think it's early May or the next couple of weeks where the Fed will announce what they're doing with the interest rate. So let's stay tuned for that. So when it comes to the Canadian stock market, let's check out, of course, we'll start with the all-in-ones. We'll start with HYLD. And there's some big news with HYLD. I know it's not very popular news, but HYLD recently reduced their dividend from 14 cents a month to 12 cents a month. And of course, when this sort of news happens, you could count on this channel because we have good relationships with many income-oriented fund managers, including Hamilton ETFs. And in case you missed it, guys, very important to check out this video here. HYLD reduces dividend by 14%, where I discuss for 35 minutes the dividend reduction, why they had to do it. It's actually very well justified. So make sure to check out that video because I promise it will answer all your questions. So HYLD, a lot of people predicted it was going to get dumped after. That's actually the opposite happened. The assets under management actually increased, and it's actually really close to getting to 500 million. Of course, you have they recently also updated the holdings, which is also kind of part of, what we talk about in that video. Make sure to check it out if you missed it. But now you could see that they have more ETFs. They reduced a little bit the ones from Global X, XYLD, QYLD, RYLD, and they introduced 2 Horizons covered call ETFs, which are basically kind of index based. QQCC, which I've covered before on this channel, which is the NASDAQ. And then you have USCC, which is US large cap, basically your S&P 500. So now HYLD has multiple strategies, covered call strategies by multiple providers. So you have JetQ, which is NASDAQ from JP Morgan, which in case you missed the video, really, really good video you should watch where I interview Hamilton Rayner, which is the main portfolio manager, really, really good fund. But these JEPI and JEPQ, so JEPI is S&P 500, JEPQ is NASDAQ 100. Their monthly distributions can vary based on the volatility. So since the market has gone up recently and is doing well, volatility has gone down. So the distributions have gone down for JEPQ and JEPI, which is the main contributing factor of why HYLD had to reduce their distribution. So it's nothing to do with the market conditions, the upcoming recession, the fund being bad. It's simply based on volatility. It's a very important concept to understand if you're investing in covered call ETFs. They generate income with volatility. So now you have QQCC, JEPQ, and QYLD, all NASDAQ index-based covered call ETFs with different strategies. And now you have JEPI, USCC, XYLD for the S&P 500. So nice diversification. They reduced the gold a little bit, which makes sense because gold is actually much less. It's maybe 3 or 4% or even less than that of the S&P 500 mix. Remember that HYLD is trying to replicate the S&P 500 sector mix. So I really like this new combination of funds because there's less of the Ds from Global X, which have more aggressive covered calls, will probably be now HYLD will probably be able to capture more of the upside if the markets go up. So again, not going to get into too much details on it, but check out this very important video if you're a holder of HYLD. When it comes to HDIV, by the way, we also discussed HDIV in that video. No news. It's just flying completely perfectly. It's still outperforming XIU or the TSX 60 by a huge margin, and the mix hasn't changed much recently. And of course, HYLD is more US focused. This one is more Canadian focused, and again, a nice diversification of fund managers and covered call strategies as well. There is HMAX. So HMAX is Hamilton's newer ETF, which really focuses on the Canadian financials. It's literally called Canadian Financials Yield Maximizer. There's no leverage here, unlike HDIV and HYLD, but they are currently writing more aggressive covered call options, which means more income, less upside in case the Canadian financials take off. So this is really if you're a yield investor like myself, and stay tuned because I have an upcoming video where I'll talk to Rob Wessel about HEB, about HMAX, about HCAL, all their Canadian financials ETFs. In case you didn't know, Hamilton ETFs and Rob Wessel, the co-founder of Hamilton ETFs, is a financials and Canadian bank expert. So stay tuned for that upcoming video. And some of you might have noticed a small distribution reduction, so 18.5, and then they put it at 18. Why did they do that? What is that all about? Well, stay tuned for that video because I asked Rob about it. So, of course, you have HDIF from Harvest, which is the sponsor of today's video, going really well. No news here. Phenomenal yield of still over 10% now. The big news with this one is in here it has Hubble, HUBL, which is US banks, which is actually, I would say, an undervalued sector right now because of the US banks fiasco. I'll talk a little bit about that later. And I got an upcoming video with Michael Kovacs, the CEO, and we're going to discuss all about it as well. So in terms of the all-in-ones, those are it. There's also Brompton, of course, BMAX, which is the latest all-in-one to come out on the market. No news here. It's doing very well. These guys declare their distributions way in advance, or every quarter. So you have all the distributions until July are already declared, and they have not changed them at 10 cents a month. And stay tuned because I'm also going to do a follow-up with the ETF spokesperson from Brompton, and we're going to talk a little bit about BMAX. So a lot of great Q&As coming up. This is one of my favorite things of doing this channel, honestly, is to have all these great relationships with the fund managers that I'm actually invested in, products that I'm invested in, to bring you that information. Last of the big six, or the big five, is EIT. Nothing to say here except EIT is still the king. It's still amazing. Always trading at a small discount. Remember the first four, HYLD, HDIV, Max, HDIF, and BMAX, these are all ETFs, but Canoe EIT Income Fund is a closed-end fund. So we got to look at what the NAV is, compare it to the stock price to make sure we're not overpaying. But EIT is always trading at a small discount for some reason. So it's worth 13.27, but the stock price is 13.07. So you could pick it up a little bit lower than it is. So all are great pickups as usual. Of course, a little bit disappointing with the dividend reduction of HYLD, but it's still very, very high yield of just under 12%. The objective and the mission of the ETF hasn't changed either. And again, check out that video with Rob Wessel here where we talk all about it. Moving on to closed-end funds or split share funds, nothing really stands out to me, honestly, guys, this month for the Brompton ones. Even the Quadrovest ones, there's nothing really trading at a discount except for LCS, but this is more of a niche split share fund that has historically missed a lot of dividends in the past. But hey, if you're very bullish on life insurance companies, LCS is a good idea or a good option for you because it's actually trading as of April 27th. At a discount because it's worth 637. You see 637 is under the NAV column. So what is it worth? 637, but you could buy it for cheaper, 595. So if you're very bullish on the life insurance companies, go ahead. Everything else, or they're more, I would say, popular split share funds like DGS, GDV, LBS, SPC, they're all trading at premiums. DGS did declare the dividend, and it's definitely the one with the smallest premium. You see here, it's worth 519. And you could pick some up for 570, but still a premium of over 10%. I typically would wait it out. Middle field, so ENS is actually getting close. The premium is under 10%. So it's, ENS, of course, is a split share fund that only owns Enbridge. And the NAV is 14.21, or it's worth 14.21 a share. You could pick some up for 15.20. So it's pretty close. It's about 6 or 7% premium. So it's a good pickup if ever you're in the market for some Enbridge. The real estate one, which is the third biggest position in my portfolio, my go-to for real estate, is trading at a premium of about, well, you know what? Let's just calculate it together. So of course, to discover the premium, you take the stock price, 14.62. Of course, this is as of April 28th. Got to make sure to check the dates. Divided by 1313 minus 1 times 100. 11.34% premium. So you got to pay an 11% premium. Not bad, but I still like to wait until the premium is under 10%. But hey, if you're looking for real estate, RS is still my go-to. Bitcoin and Ether. So finally some good news. So you guys know that one of my objectives in my personal portfolio is to have no more than 10% in crypto. BTCY, ETHY is the only way I would ever invest in crypto because first of all, it's only Bitcoin and Ether, the two biggest ones, and it's with covered calls. So I'm not super bullish on Bitcoin and Ether. I really love the covered calls, and this just adds some diversification to the portfolio. The good news is that they recently increased the dividends finally on both of them. So the Bitcoin one has been 2 cents for a while, and now it just jumped. It doubled to 4 cents. Keep in mind, these could vary every month, guys. It's based on volatility, but these ones, Bitcoin has finally started to go up a little bit in the last couple of months. Ether as well, the dividend increase wasn't as big. It went from also to about 2 cents to 3 cents. So still a pretty big increase. But again, they could vary every single month. So that's it in terms of the overall. Now, what is undervalued? Well, it's pretty much the US banking sector. US banks, especially, financials, but more US is really undervalued. So you have 3 covered call ETFs that all on the Canadian market that all focus on US banks. Call from Evolve is the one with the highest yield by far of over 13%. So this would be a good time. If you're an opportunistic investor, it's a good time to buy US banks. Call is a good option. You have ZWK if you're a little bit more conservative investor with the covered calls. BMO is very conservative with their covered calls, but you're getting at about 11% yield. Make sure to calculate it yourself, of course, because this, by the time this video comes out, it could be outdated, of course. And last but not least, you have Hubble from Harvest, which is the lowest yielding one right now, but it's still high at over 9. And what I wanted to mention is that in case you don't feel comfortable buying a US banks ETF, well, in that case, you could consider HDIF. That's what I've done personally. I've been adding a lot of HDIF in my portfolio because one of the 6 ETFs inside of HDIF is Hubble. And stay tuned for that video because I talked to Michael Kovacs all about it. Are they going to keep Hubble in HDIF? Are they what's the rebalancing when they rebalance? Does it basically dollar cost average Hubble. You guys know what I'm talking about, right? So stay tuned for that video. That video right here, it's actually ready to go. It's going to be published on May 10th, where we will discuss a bunch of things, including their 2 new ETFs, TRVI. So TRVI is a new covered call ETF that focuses on the travel industry. Very nice, over 10% yield. We're going to talk to Michael all about it. And of course, their new non-leveraged version, HRIF, which is a non-leveraged version of HDIF, the all-in-one. So we're gonna talk to Michael all about it. We're gonna discuss US banks, these 2 new ETFs, and a really good discussion on ROC and return of capital. You don't want to miss it, because it's probably one of the top 3 questions I get. ROC, return of capital, a lot of negative connotation around it. Stay tuned for that video. Mark your calendar, May 10th, it will be out. Let's check out what's going on in the US market now when it comes to the high yield fund landscape. All right, when it comes to the US market, the big 5, or the 5 covered call ETFs, which I feel are the best and biggest and most popular, are QYLD, RYLD, XYLD, JEPI, and JEPQ. So any news on these? Not particularly, but the big news is for actually all of them is that I've had the pleasure of interviewing Hamilton Rayner, who actually is the head portfolio manager and head of derivatives at JP Morgan. So very amazing interview. If you own JEPI, JEPQ, if you own HYLD, you gotta watch this interview, because this guy he's the one managing these funds. It's a great Q&A. You should check it out. I also did a video right before that where I reviewed JEPQ and JEPI in detail. And guess what? I'm going to be doing the same thing for the Global X ones, QYLD, RYLD, XYLD. So the review video is already out. By the time this picks video comes out, the interview with the income suite director at Global X is going to be out. It's actually coming out on Wednesday. So make sure, if you own these 5 ETFs or any one of them, to check out these upcoming videos. So QYLD, RYLD, XYLD, just chugging along, monthly distributions, a rinse and repeat strategy, right? So the distribution or dividend for QYLD and RYLD have slightly increased. That's because their net asset values have slightly increased. Remember, you can get the dividend is going to be approximately 1% of the NAV basically every single month. Just XYLD slightly a little bit lower. I think the day they wrote a call, the S&P 500 or XYLD was a bit lower, but I do expect it to be about 39-40 cents if the net asset value stays at about $40 here. JEPI and JEPQ, nothing to report either. Remember, guys, very important. Their monthly distributions for these are going to vary based on volatility. The lower the volatility is, the lower distribution we could get. You see that they've been a little bit lower than when the market volatility was a bit higher. Same thing for JEPQ. So expect still high distributions of about 7 to 9%. When it comes to JEPI, 9 to 10, 11%. When it comes to JEPQ, again, we've discussed the yields or the potential yields with Hamilton Rayner, so make sure to check out that video, very important. But as you could see, I do expect a little bit higher dividends with the JEPQ, because the NASDAQ is more volatile than the S&P 500, so it's completely normal. So that's it for the ETFs. All of them are good buys, of course, all the time, because they cover basically the whole entire US stock market. Of course, JEPQ and QYLD is going to be a little bit more NASDAQ focused, a little bit more volatile. And you have your RYLD if you're interested in getting all the small to mid cap companies in the US. SVOL, one of my favorite alternatives style ETFs, doing very, very well, still beating the S&P 500 here in the past year. Very good numbers, very low management fee, and stellar consistent distributions of 32 cents a month. I've done a couple of videos with SVOL's fund manager, ETF manager. Make sure to check out those videos. But this is definitely a really high and core position in my personal retirement account. You guys know that in my retirement account, I go with my RSP. I tend to go with the US listed funds. iShares, they have 3 really phenomenal fixed income style. I can't believe I'm saying this, but fixed income style ETFs that are good and interesting because of covered calls, not because they're fixed income. So you have TLTW, which is the boring 20-year government US bond. LQDW, which is just writes covered calls on the LQD ETF, which is investment grade or good quality corporate bonds. And then you have the one I own, or my favorite one. Of course, it's the least popular, in terms of assets, HYGW, which writes covered calls, aggressive 100% at the money covered calls on HYG, which is just high yield corporate bond. So a little bit, corporate bond quality not as good as LQD, but the good news is with these ones is in the last month in April, all of them had a huge jump in distribution. Look at this monster 85-cent dividend here. So again, these are covered call ETFs, everyone. Again, you got to expect varying distributions. Depends on the volatility of TLT, of LQD, of HYG. So these are just great, I would say, fixed income options, great alternatives, as well as SVOL to add to your core positions, which I feel would be the first 5 ETFs would be great core positions. But these ones could be core positions as well. They're really good. They're managed by iShares, very, very big, very, very popular. And even SVOL, I mean, it's growing significantly. It's already at over 200 million. So it's very, very popular. That's the ETFs. You guys know these are my favorite covered call ETFs or income-oriented ETFs on the US market. Of course, there's other ones, right? There's one like Devo, for example, which is kind of like a JEPI, but even less aggressive. I haven't covered it, but the yield is only about 5%. But it's a very similar strategy to JEPI, but much, much less aggressive with the covered call. So moving on to closed-end funds and other things now. CLM is, of course, the very big and popular and misunderstood closed-end fund on the US market. It's trading at a 15% premium right now. The big news with this one is where the heck is the rights offering? So they haven't done it yet. My guess is that maybe the premium is not high enough. So this would be I would say an okay time. Anything under 15% premium is an okay time to buy CLM. Under 10% is a great time to buy CLM. Very rare that I've seen that. I don't think I've ever seen the premium under 5%. If it's, if this number is 5% or less, I would be buying CLM for sure. When it comes to the all-in-one closed-end fund option, so in case you're like me and you don't want to invest in specific closed-end funds because there's hundreds of them on the US market. There's PIMCO ones, there's BlackRock ones, there's Nuveen, there's all kinds of great closed-end funds on the US market. But instead of picking and choosing, you could get an all-in-one option. There's 3 of them. The most basic one is YYY from Amplify ETFs, which manage Devo, by the way, the ETF that I mentioned. So this is your basic option because there's no leverage on top. It basically holds 45 different closed-end funds, so you get some diversification there. No really big news here. The distribution hasn't changed, and the most important thing is what is the average discount that you're getting overall, and it's at 8.86%. So basically what this means is the average premium or discount of the 45 closed-end funds in YYY is minus 8.86, which means that's a discount, which means it's very, very attractive. RIV is the one I own, the one I like. So this one is trading at a nice discount as well. So RIV, unlike YYY, YYY is an ETF that holds closed-end funds. RIV is a closed-end fund that holds closed-end funds. So not only is, if you open the fact sheet, very important, not only is the average portfolio trading at 11.3% discount in RIV, but RIV itself is trading at a discount. So this is a really good pickup. I have this in Erica's RRSP, my wife's RRSP on drip. So I'm happy I'm just buying these undervalued cheap shares at $11 when they're actually worth over $12. So very nice discount, good pickup. Remember RIV and the closed-end fund market in general, guys, is very, very heavy on the fixed income, which has not been doing well, which is why the YYY, RIV, and even CEFD, the third option, the most aggressive option, have done really, really bad in terms of stock price. That's also because of the leverage. RIV and CEFD are highly leveraged as well, so they will go down very hard and they will go up very hard as well, though, when the closed-end fund market recovers. Nothing to discuss on CEFD. This is more of an index-based one. It has 100 of them or over 100 of them. It is an ETN, however, but it's definitely the most aggressive because it has 50% leverage, whereas RIV has something like 28, I believe, 26.8% leverage. So this is almost double leverage. So you could expect, higher yield most probably, but a lot more volatility. So that's it for the closed-end fund market. Definitely undervalued, a good time to pick some up. RIV I own, CEFD I own, and speaking of undervalued, even a sister fund, OPP, which I used to own and sold myself, is trading at a humongous discount right now, almost 15%. You see, you could pick it up for about $8.40, but it's worth $9.83. OPP, however, is basically all fixed income, and it's very heavy on mortgages. So if ever you're very opportunistic, you want to get into mortgages or MBS for short, OPP would be a great way to do it, because you're getting 14% yield, over 14% yield right now because of this big discount. Other cool alternative, very high yielding ETFs are, of course, the Yield Maximizer, Yield Max ETFs. You guys know I own both of these, OARC and TSLY. I've done a video on these where I talked to the options manager. Very interesting. They actually just came out with the Apple one, APLY. The first distribution hasn't been declared. It will be declared soon. My prediction is that it's definitely not going to be as high as the Tesla and the OARC one, because Apple stock is much less volatile than Tesla or the Cathie Wood's ARC ETF. But if you like Apple, but you want income off Apple, APLY might be a good option. We'll have to wait and see when it comes to the dividend. And I recently discovered, a lot of people have been messaging me about this ETF, which has been out for a few months now, KLIP, which basically writes very, very similar strategy, by the way, to these Yield Maximizer ETFs. They're writing pretty aggressive at the money covered calls, as far as I could tell, on the China Internet ETF. So on the KEWB ETF. So what they do is, this is actually a classic covered call strategy, unlike Yield Max, where it's a synthetic covered call strategy. Again, if you don't know what I'm talking about, check out my Yield Max videos where I go over these ETFs in detail and explain the strategy. But this is a classic covered call strategy. So they will own the KWEB ETF, which is an ETF that owns Chinese technology companies. And why would you want to own this, or why does a cover, here it is, by the way, see, they actually own it itself. But cover call strategy, guys, remember, it does really well, or could really generate high premiums or high dividends when something is very volatile. And a technology ETF that only has Chinese companies, it's going to be very, very volatile. And check out these insane distributions. 4 of them have come out. The first one, 56 cents, but that's probably because the ETF only came out in mid-January, so it's half of a dividend. But the last ones have all been over $1 a month, which literally translates into a yield of over 60%. So the same kind of deal, or the same type of yield, crazy yield you could get from OARC and TSLY. So I will probably be adding a little bit of this in my portfolio. And the funny thing is that Yield Max actually wanted to come out with an ETF that does covered calls on KWEB, but I guess Crane Shares either copied them or stole their idea or whatever, but they got to it first. So very, very interesting stuff. I hope more and more of these ETFs are going to come out, because on the US market, these are very, very crazy high yields. And I actually reached out to Crane Shares, by the way, and see if I could give you guys or provide you a Q&A with a fund manager where we could talk about this. So this is basically the overview of the US market. Overall, the US market is doing fairly well. A lot of great high yielding options we have here. Hey, don't go yet. I have some important reminders, including some more recent ones, and I'll try to keep it as brief as possible. And for everything that I'm about to discuss, the links and info are in the video description below. So first of all, if you didn't know yet, I do offer a one-on-one coaching session where you'll have a 1-hour Zoom call with me where you could ask me all the questions you want, and I'll help you and assist you best I can. Just remember that I am not a licensed or registered financial advisor or planner. So to book a session, go on my website, passiveincomeinvesting.ca, and right there on the homepage on the left-hand side, there is a small video. Watch that video to know how to book a one-on-one properly with yours truly. Also on my website, you could purchase my digital product, the Ultimate DIY Investing Package, which is on version 4 right now. It comes with lifetime updates, so you only have to buy it once. And this is really a reference tool or a companion tool to help you build your own portfolio according to your needs and your objectives. It has lists of funds. It has sample portfolios for both Canadian investors and American investors. So make sure to check it out on my website. I actually created a video which shows the product from A to Z, because I don't want you to spend money unless you know exactly what you're getting. So make sure to check that video out on my website. And don't take my word for how good it is. Check out the reviews. There's over 300 of them, and they are all 100% real reviews. So here's some more updated news or recent news. I am now on Blossom, a new investing app designed for investors. I've been using it for a few weeks now. I think it's really, really great. It has a really cool feature where users could actually add and share their portfolios and what they're buying and selling every day. So you could actually link your investing account so it's updated automatically on a daily basis. I recently added my own main portfolio, so you could follow how my portfolio is doing live and what I buy every month. Really, really cool. It's like a mix of Facebook and Twitter, but specifically for investing. So get on your phone, click on the link in the video description below and download the app. It's 100% free, so you too could share your portfolio. Just remember to look for me and follow me. My username is Adrian, PII altogether. Also, I do have a referral link for Questrade, so you could get $50 worth of free stock purchases. This is the Canadian discount broker that I use and I recommend. Unlike Wealthsimple, the other popular discount broker in Canada, you could drip everything you want. It has all the stocks and it also has dual currency accounts. Very, very convenient if you're buying both Canadian stocks and American stocks. I have a Questrade video, by the way, which gives you a little tour of the features, so make sure to check that out. I also have a referral link for PASSIV. This is the portfolio tracking tool that I use to consolidate all our accounts to get a nice bird's eye view, so you can consolidate all the information together for easy tracking and stats as well. Also, our Facebook group, Passive Income Investing, is now an invite-only private group. So to join it, you need to click on the link in the video description below and give the group a like to get invited. So we take pride in making this one of the best investing Facebook groups out there with over 13,000 members. There's no scams, there's no spammers, and negative and doomsday people, we kick them out right away. Also, follow us on Instagram if you want a little bit more of our personal journey here in Panama. And lastly, just remember everyone, I am not a licensed or registered financial advisor. This channel is all about my personal investing journey and how I invest to generate high passive income from a diversified portfolio of high yield funds. It's for educational purposes only, so don't forget to do your own research and due diligence. And of course, stay safe everyone, stay healthy, and of course, stay passive. See you next time.